G'day everybody and welcome back to the Scale HQ podcast. This is part 2 of a 2-part podcast. If you didn't hear part 1, this 2-part series is about the 8 mistakes that I've noticed that founders make that prevent them from being able to achieve one of the 3 options in the Holy Trinity. What do I mean by that? Most founders I know are very keen to somewhere in the next, 3 to 7 years. They usually say 3 to 5, but let's say 3 to 7. They want to do one of 3 things. They want to be able to step up, i.e. take on investment, scale up to the next stage, bring in some capital, maybe bring in an investor and keep growing their business. But get a few chips off the table, bring in some capital and some horsepower and go faster. So that's the step up option. Some want to be planning towards a step back. They want to keep the business. They would like to be able to build it in such a way they can install management and they can step back into a non-operational role and they can provide guidance and oversight, but ultimately then they keep the dividends and the cash flow of the business and retain their equity, or at least, the majority, and sell some down to management. That's the step back. And then finally, of course, some people want to step out. They want to be planning for a full exit. They want to sell 100% of their shares. They want out of the business at some point in the future. They want the sort of golden pot that comes with that. And whether that's in a 1-stage deal or a 2-stage deal, that's what they're looking for. So this is the second part of a 2-part series where I'm unpacking the 8 mistakes that I see that prevent founders from achieving any of those 3. And so if you haven't listened to the first part, I highly recommend that you go back and listen to the first one. And today is the second part of that. Make sure you listen all the way to the end, because I'm going to tell you, of course, at the end, I'm going to summarize the first and the second part, but I'm also going to tell you what you can do about it. I've got a diagnostic tool that I think you'll find very helpful for auditing your own business and seeing where your gaps might be. And that's more detailed than just at a high level of the 8 steps. There's actually, 34, 35 sort of ingredients, if you like, or practices that underpin success in those 8 areas. So I'm going to tell you about the mistakes, but then in terms of what you can do about it, I'm going to explain that at the end. So I hope you enjoyed today, and I hope you go back and listen to part 1. It's going to make more sense if you do, and enjoy. And I look forward to seeing you again soon.
Welcome to the Scale HQ podcast. I am Sean Steele, and I'm a growth mentor, digital nomad, a massive metalhead, and the founder of Scale HQ. And you, more importantly, are a founder of a 7 or 8-figure services business who is finally ready to get serious about scaling up or securing a step back from your business or a life-changing exit in the next 3 to 5 years. And if that's you, then you are in the right place, because with over 100 million in revenue growth across my last 4 companies and many acquisitions under my belt, I have spent my whole career figuring out what makes businesses more valuable, scalable, and sellable. And I've learned a couple of things, and I'm thrilled to have an opportunity to share those with you today. So welcome to your fortnightly dose of practical strategy, founder success stories, and expert deep dives to help you finally get a return on all that sacrifice that you've made in your business. Welcome to the show. Let's dive right in.
So let's look at mistake number 5. Mistake number 5 is about financials. Having poor financial visibility and insufficient or inappropriate working capital gets in the way of growth and gets in the way of good decision making. So what does this look like? All right, try these 4 questions on. How many days does it take in your business, on average, between the day you spend $1 to get a customer to when they pay you? How many days is that? 20 days, 100 days, 50 days? And how much do they pay you before you incur any delivery costs? Question 1. Question 2. Do you have a good understanding of how much it actually costs you to acquire each customer in detail, like all the sales and marketing costs put together, any cost that goes into acquiring customers? Do you know exactly how much that is? And do you know how much for each of those customers that you secure, how much gross profit contribution you get and how much bottom line contribution you get from, like, if it costs you $1,500 to get a customer, do you get $1,000 in profit, $2,000 in profit, $3,000? Like, what is the ratio between your acquisition cost and the profitability of every customer? Question 3, do you have an integrated 3-way financial model, meaning you get monthly financial reports that link together your profit and loss, your balance sheet, and your cash flow statement? And ideally, a forecasting model that allows you to be that gets updated, on a monthly basis based on the year-to-date performance. So you can see what's going to happen in the future, and you can see where your cash flow or your profitability might get squeezed between now and the end of the year to allow you to make better financial decisions. Finally, do you have access to working capital, a sufficient cash balance or working capital facility that can be invested in growth, whether it's, accessed through invoice financing or trade financing or lines of credit or any number of other instruments to give you access to cash to fund growth? Or do you have less than 3 months worth of expenses in your bank account and no access to anybody else's money, always just leveraging your own cash, and you're always worried about investing it in growth? So you end up kind of inching along incrementally. So let's talk about how these impact your Holy Trinity. if you want to step up and take on investment, if you don't have these in place, you don't actually know your numbers well enough to be taking on investment from somebody else and confidently be able to say that you can manage and deploy those funds appropriately. It's not actually fair on the investor. They need to know how well their investment will turn into profit and into cash and how quickly. And so your financial information needs to be watertight. They're not going to invest in a business that doesn't have their financial house in order. For a step out, well, buyers aren't going to want to inject capital into a business unless they know where and how it gets spent and how fast the model turns it back into cash. They actually need to understand that. And so they're going to look for you to understand that if you're looking to sell. Finally, if you want to step back, it means it's pretty hard to do because your financial information is so opaque. You wouldn't be able to confidently make decisions as a director without having to get into the business and ask 1,000 questions of a whole bunch of people. You couldn't hand over financial responsibility to anyone else because you don't have sufficient financial governance yourself. You need that financial governance, that quality financial information so you can run scenarios on decisions. Can we afford to make this decision? When can we? What's the impact on profit? What's the impact on the balance sheet, etc.? You need to be able to ask and answer those questions as a director. And so if you don't have the platform, it's going to be hard to do. So that was number 5, which was all about financials, having the right kind of financial platform in place. Big mistake not to have that will prevent you and have a big impact on your ability to get to your 3 your holy trinity.
Now, if you are keen to step your business up to the next level, like by taking on an investor or stepping back and installing management so that you can enjoy dividends and get out of operations, or perhaps you want to secure a life-changing exit in the next 5 years in your business, well, whichever one of those 3 things you want, you are going to have to really think about what you prioritize over the next few years, because it's going to matter a lot as to whether you actually achieve those or not. And I see lots of founders staying trapped in their businesses way too long because they're not sure what to prioritize when it comes to the sort of, working on their business. Like, great idea, but what do I actually focus on? And unfortunately, the things that got you to your first million or 2 are very different from what you're going to need to do to achieve one of those 3 outcomes. And that's why you're going to love my Scale Scorecard that I've developed. It is a new diagnostic tool which I'm making available for free so that you can figure out where you're at right now and what you should focus on next. But it is not some made up fluff that I read in a book. This is real world scaling, investments, exits. It's my experience from having grown 4 companies by a total of 100 million in revenue. I've done due diligence on hundreds of businesses like yours as an investor. I've bought multiple companies. I've integrated them. I've led multiple turnarounds. So I've built a really deep understanding of what actually makes a difference in you being able to achieve one of those 3 outcomes. And so what I've done is reverse engineer all the ingredients that you need to think about across 8 key areas of your business into a simple survey. You can take it in 5 minutes. It's going to ask you 35 questions about your current strategy, execution, leadership, team, financials, offer, sales, and support. And then it's going to give you personalized recommendations about what to focus on and an opportunity for a free live growth audit where I will unpack your results with you if you'd like, and where I'll also give you my best thinking on what you should focus on in the next 90 days to build momentum quickly. No charge, totally free. So if you would like to maximize your chance of securing that step up or the step back or the step out, then come and find out your Scale Score at scalescorecard.com.au. It's scalescorecard.com.au, or just go to scalehq.com.au and click the button to take the quiz.
So let's look at number 6, mistake number 6. Mistake number 6 is actually about the core offer of the business, the sort of the product or the service offering. Inefficient offer design, which misses the opportunity to maximize margins and lifetime value. Let me ask you a few questions here. Do you have a super clear ideal customer profile and a clear and punchy brand promise that articulates what you're promising to that customer as a business? Do you have a unique and differentiated offer that actually makes it almost like comparisons to your competitors almost irrelevant because they're not apples and apples anymore? They're not even comparable. It tells customers exactly what they can expect in terms of outcomes and by when, like in a really tight and clear way. Do you have a ironclad, super duper risk reversal sort of guarantee that makes it an absolute no-brainer for a new client to try you out? And have you really thought about your pricing? Have you pushed and tested the pricing boundaries properly? It's often more elastic than you think. Do you have outcome-aligned pricing options where you get paid, some variable component based on performance? Do you have pricing tiers that produce industry-leading profitability per sale? If you don't have any of these items in place, then you're leaving lots of money on the table. No question. So let's have a look at your holy trinity. And what's the impact of making this mistake on the holy trinity? Well, if you're looking to take on investment or sell the business entirely, a step up or a step out, where the first 5 mistakes might mean, investors or buyers will be thinking twice or more hesitant, maybe this will actually get them excited if they're good at this stuff. But back to because they might go, well, this is not a deal breaker. Let's be clear, it's not a deal breaker for them. They might just say this is an opportunity. But back to my original context. if you'd done this 3 years before you wanted to sell, how much more would you have in EBITDA? How much stronger might your ability to sell to customers and to acquire customers be if you had bold, punchy, really differentiated, ballsy offers that delivered above market profitability compared to your peers? It's not going to make a buyer and investor say no, absolutely not. But it means you're leaving money on the table. And so if that is your outcome, it's something that you should be thinking about prioritizing. From a step back perspective, okay, let's assume you're installing management. It doesn't matter too much whether you've done this before a step back. But it is harder as a director to sort of get involved in the design of this. Your CEO or your GM may not be great at this stuff, and you're trying to give them some room. You're trying not to overmanage them. So it might be a little bit harder to work through the iterations that it might take to land some of these pieces. But one thing I do want to say is getting your offer design and your pricing right, doing this well tends to accelerate sales success. And so you actually want to be doing this, and this is the reason why it's further down the mistake list. You want to be doing this after you've started addressing the other issues. Why? Because otherwise you'll get bigger without getting better. You've got a chance of breaking the business, like breaking the people, breaking the systems, breaking the processes. Actually, you'll be expanding the nightmare of putting out fires and people problems, which I know you absolutely hate. You'll be taking them to like a whole new level of awful. You'll lose good people. The list goes on. And that is why I teach my founders about strategy first, then execution, then leadership, then culture and success enablement, like the team stuff. And then we dig into sales and marketing, like offer design and customer acquisition. Why? Because you don't want to put pressure on the top half of a house if the foundations are still shaky. They're going to fall over. Offer design, big opportunity, not a major deal breaker if you haven't done it, but more about what you're leaving on the table. So that is number 6. Mistake 7 is about having weak lead generation and sales, a sort of weak lead generation and sales ecosystem that prevents the scaling of revenues. So let me ask you some questions here. Do you have a predictable and scalable lead generation strategy in place? Like, do you know how much the cost of acquisition is for each marketing channel? Can you scale up the ones that are working to allow you to at least triple your size? And are they that scalable? Can you triple your size in the next 3 years using the same strategies? What about the sales process? Are you confident that your call frameworks, your sales collateral, your sales process is producing high conversion rates compared to the industry? What about nurturing? Do you have a solid lead nurturing process, materials, touch points that helps to take people from I'm just researching to I'm interested to I'm engaging with you to I'm evaluating you to I'm ready to buy? Do you have a process to actually take people through those stages? And if you have a sales team, and many of the founders listening today will have a sales team, are you able to get your sales team to competent in less than 3 months because you've got a solid recruitment process, onboarding, training, well-developed, sales KPIs, commission models, reporting, all of that stuff? Do you have a sales management approach that you know is helping your salespeople move deals through the pipeline, if there's like more than one stage of pipeline, at an optimal speed, and so that deals aren't going stale in the pipeline? You can kind of making the most out of your sales opportunities. Are you doing a regular return on investment analysis, month in, month out, on every lead source, on every salesperson's performance, like an actual profit and loss statement essentially for each source and sales role? If this is a big fat list of no's, what an amazing opportunity for you. I mean, ultimately, it's going to take investment and it's going to take time, and it's always going to take longer, cost more, and be harder than you think so. But it's going to be so worth it, because your ability to scale is first addressed by getting scalable delivery, rhythmic execution, all that stuff in place first, and then putting the fuel on the fire on the front end to turn your business into an acquisition machine. So let's talk about the implications of not having this in place if you want to do your Holy Trinity. You want to take on investment. Investment's going to be an issue for you. If you don't have excellent handle on your sales and marketing metrics, the cost of acquisition, profit per customer, analysis of return on investment by channel, they don't want to deploy money and watch it slide through your fingers. They want you to be ready for scaling, where all you need is actually access to cash that you can put straight into the sales and marketing machine, and you know what's going to come out the other side. They don't want to pay you to build the process. They just want to feed, more marketing and sales activity into the top of the funnel. If you are planning on a step out, you want to sell the business, well, you'd want to be building this stuff 3 or 4 or 5 years out from a sale so that you can maximize the return. And a buyer wants to know that you've got a structured and consistent acquisition process that isn't relying on you as the founder. Otherwise, the vendor cliff, meaning, you buy the business and all of a sudden the business tanks because the vendor was really holding the sales relationships, they were too involved in the sale or the marketing, that's going to get realized. So the revenue is going to tank, their valuation will have been wrong, they will have overpaid, risky for them. If you don't have a well-oiled customer acquisition machine, it's risky for them. And for a step back, okay, you want to install management. Well, this could be developed over time, for sure, no question, if the business is stable enough. So no biggie if you haven't already done this before a step back, unless your GM or CEO doesn't know how to build a sales and marketing engine, or you don't have somebody in place who does. So you better have some good players in that space if the leader is not skilled in this area. Otherwise, the blind leading the blind. Or you can maybe tap into some external guidance from suppliers or mentors to mentor your internal team. That's all definitely possible. So that is number 7. Number 7 is about not having a well-oiled customer acquisition machine that is scalable. So let's talk about mistake number 8. Mistake number 8 is about support. It's about having a lack of appropriate external advisory and peer support for you as the founder. In my first CEO interview, I was asked, I thought, a really insightful question, which was, Sean, who do you turn to for advice or perspective when you have strategy issues, sales and marketing issues, leadership issues, financial issues in the business? And I asked why they asked the question. And the group CEO who was hiring me said, well, as the CEO, your job is not actually to know everything. It's to be better at everybody else at leveraging your resources to get the answer quickly to address the gap. So your support network is absolutely critical. You're going to face new challenges every day that you don't know how to deal with. And so your ability to tap into knowledge and solve things fast is actually more important than you knowing the thing in the first place. And I thought that was actually really profound. And it got me thinking, who would I go to? And over my career, I've been really fortunate to actually be good at and get energy from. There's plenty of things I'm not good at. But one of the things I am good at is connecting with people that I like who are more competent and capable than me in different areas like HR and legal and sales and capital raising. And the list goes on. And I am good at keeping those relationships alive. For example, I'm in Australia right now. If you're watching the video, you can see I'm actually in a hotel room in Melbourne, an apartment. And on this trip to Australia, I've probably got 15 to 20 catch-ups, I would say, over the course of 3 weeks that aren't business development, they're not sales, they're not even my clients, which is my primary reason for being here. They're my network. They're mentors in different areas. They're people I can turn to if I need help. They're people who can give me fresh, but, informed perspective or teach me how to do something I don't know how. Previous bosses, peers, friends who built different kinds of businesses to me. Friends who built different kinds of businesses to me, but who succeeded in scaling and who are capable CEOs who can challenge me as peer mentors. And I also, of course, value the virtual mentors I've had throughout my life, the authors of all the books and the back in the days of CDs and tapes, Tony Robbins and Jim Collins and Salim Ismail and Vern Harnish, and all of these guys have been super formative in my years growing up as a leader. And what's been amazing to me is that my network of suppliers and partners and even peers in some states have become the network of my clients, because I'm happy to introduce people when I know the person on the other side of that transaction is going to be high quality and ethical and will do a good job for a fair price. Life's too short to be testing and trialing idiots all the time. And so I love saving my clients those efforts. But what I've noticed since I started with Scale HQ, and I'm dealing with founders of 1 to 30 million businesses all the time, particularly in services, is that their support networks before we start to working together are very thin. And why is that? Because usually they've grown up in a particular field, they've spent 10 or 20 years in one career, and they've become a practitioner or an executive or whatever in that field, and they've gone out on their own, they've started their business and it's working, but suddenly their network doesn't have the same problems as them. So they were just dealing with people who were in the business as well. They weren't dealing with other founders or external suppliers, and they're on this scary island all alone with no perspective. And yes, they've got often some supplier relationships which can offer advice, but it's not usually independent. It lacks context because that person is usually only looking into one area of the business, not interrelated issues. And when they get advice from friends, well, that's very unqualified. They've never been to where the founder wants to go. They don't have many peers with similar sized businesses, so they're not getting much peer support. Families are super well-meaning, like friends, but again, if they haven't been to where you're wanting to go, is that really the advice you want to take when you're trying to achieve the Holy Trinity in the next 5 years? No. You want to shortcut the painful meandering, the squandered opportunities, the thousands of dollars that you end up wasting on poor decisions, which can be avoided in the majority not entirely, but in the majority, when you have a capable mentor in your corner or an advisory board or some training from someone on actually how to get the right things right in the areas in which you need to develop. And those things really make a difference when you can learn it from someone who's been there. And you may also at some point want to or need to be connected into an ongoing community of founders at a similar stage to you. And whilst that is valuable, because I've managed to get huge value out of that over the years, and I still have many friends from the CEO networks I've been part of, they don't necessarily teach you stuff. There's not usually that much structure and order. There's not being paid for their advice. So they don't always understand your business fully. And sometimes they don't want to tell you what you don't want to hear because they still want to be your friends too. I do plan to tackle the founder community side, the need for clients at Scale HQ that need community. First of all, I want to finish off the programs and the tools and the books that I'm developing for you all. And look, I know this mistake number 8, not having the support in place, sounds like a Scale HQ sales pitch. Every founder needs those things. They need mentors, they need guides, and they need quality peers at a similar level of business or beyond for their support and their perspective. Always need to retain perspective. And the more you have your head buried in the sand, the more likely you are likely to run into things that are actually avoidable and waste time and waste money. And founders who are seeing this as their sort of retirement plan don't usually want to be wasting time and money. What makes me happy is seeing founders build the support around them, whether that includes me or not. I like to see them succeeding in knocking over their strategic issues one by one, not getting stuck, not plateauing. And they need tools and frameworks and support from people who've been there and done it. I don't care if that's me. I just hate seeing people who've got something to offer the world and who have sacrificed for, 5, 10, 15 years in this business, but they're still just inching along because they aren't willing to ask for help from the right person, which may or may not be Scale HQ. It's not the default assumption. Anyway, I'm rambling now. So I know that was a lot of content, but let's summarize. Here are the 8 mistakes, and I'm going to tell you what you can do about them. If you're nodding along and going, yep, that's me, I'm coming to that. So here's the 8 mistakes. The first one, strategy. Lack of a clear strategy and execution plan. The second one is about execution, ad hoc execution that lacks rhythm and scalability. 3 is about leadership. It's about lacking capable leadership layer that can't inspire, trust, and retain your top talent. 4 is about team. It's about failing to enable individual success through clear expectations and the right support. 5 is about financials. It's having poor financial visibility and insufficient working capital that gets in the way of growth and decision-making. Mistake number 6 is about your offer. It's about inefficient offer design where you're missing opportunities to maximize margins and lifetime value of your customers. 7 is about customer acquisition. It's having weak lead generation and sales processes and ecosystem that prevent you from scaling your revenues. And 8 is about having the lack of support, not having the right support in place between advisory, peers, and all the other things that you need. What do you do about it? Well, actually, the starting point is to get clear on where your gaps are and what you should prioritize next, because you can't do everything all at once. And I've developed something that can help you to do that, which is free if you're interested. It's called the Scale Scorecard. Like, after seeing hundreds of these businesses and seeing these 8 mistakes and then being able to break those down into the constituent components, and then at the same time I was learning what worked in scaling all the entities that I was building, and over the last 4 years I've now been helping founders implement my methods. I've been able to distill it down into actually 34 elements, 34 ingredients, 34 practices that if you have them in place, and they're connected to those 8 areas. If you have them in place, you'll absolutely maximize your chance of having a step up, a step out, or a step back option that you're happy with in the next 3 to 5 years. So the tool is called the Scale Scorecard. It's a survey. You can take it in 5 minutes. You answer a bunch of questions. You're going to get a link to a personalized report based on your answers with suggestions from me that I've written on how you can improve in each of those 8 categories. So it's covering strategy, execution, leadership, your team, financials, the offer, customer acquisition, and support. Now, so far, I've only launched it relatively recently. The world doesn't really know about it much yet. The average score so far is 16 out of 34. So 16 of those, founders have got 16 of those things in place out of 34. Now, I use it with every client. This is a tool that I use with every client to help me diagnose where we need to focus next with that founder, because there's lots of areas that you can focus on. The question is, where is the best priority? Where am I going to get biggest bang for buck based on where I'm at right now? So for a limited time, at this stage, I'm actually going to create a little opportunity for you where you can have 45 minutes of my time for free to help you unpack the results. And in that session, I will help you come up with a little game plan of the top 3 priorities for you to focus on in the next 12 months based on your specific gaps in your business, so based on your results. It's a little gift from me to you. I'm going to call it a game plan session, and I'll make sure at the end of that session, you also know, of course, what is available at Scale HQ. If you need help to address any of those gaps, I'm not expecting that you need help, but if you do, you'll know what's available to you. I will be thrilled, regardless, to have set you on the right course, and I'll be grateful that you're getting value from this tool that I've invested a lot of time in developing for you. I'm not committed to doing these game plans forever. It's a lot of time for me, but I'm going to trial it. So if people like it, I'll figure out maybe how I can do more of it or how I can become scalable. And I'll do 10 or 15 of them. I'll see how it goes. If you'd like to be one of those 10 or 15 people, you need to get your butt to scalescorecard.com.au. It's scalescorecard.com.au. You don't need to take me up on the game plan to do the scorecard. You can just get on there, spend your 5 minutes, get your report, and that's the end of it. I'm also going to give you a whole bunch of free resources when you complete that report that I'm sure you'll really like, lots of templates and things. both on strategy and execution. But if you want one of the game plan sessions, you need to get on with it. Otherwise, you might miss out. So feedback. I would love some feedback. I know that was a chunky, heavy couple of episodes. And if you really liked it, I'd really love it if you would tell me. Because actually, otherwise, I don't know. I don't know if you realize this, but me talking to you on YouTube or through your podcasting platform is pretty one way. And I would really like for it to be two way. So there's two ways that you can tell me that you are listening and that you like it. Number one, hit the little notification bell or subscribe button on the podcast player. Number two, if you haven't before, and I know you can't rate every show that you're on and everybody wants you to, but let's just say you rate one episode, one show per month or 2 months. Perhaps you'll consider me next month. I'd love a review. 5 stars is great. If you think it's shit, that's okay too. I don't reckon you've listened this far if that's what you thought, but I would really appreciate you leaving a review and or subscribing so that I know that you're actually listening to it. You can also email me any specific feedback if you'd like to give me any at hello@scalehq.com.au. But going forward, future episodes, I am now that I've finalized these 34 scale ingredients, these practices, I am going to start unpacking all the pieces of that over coming podcasts. I'm going to teach you in practical ways how to implement these things. I'm literally going to walk you through a whole bunch of high-value tools that you can also download a whole bunch of them because I want you to use them. I am going to share stories about how founders are implementing them and how I've implemented them. I'm going to continue interviewing experts in those 8 areas, in those 8 sort of categories that I've talked about. I will also be interviewing some more founders in the 1 to 30 million category who are on the way up because I think it's good for you to realize that you're not alone and to hear their issues and their challenges and how they're tackling them, as well as those who've already made it. It's all valuable in shaping perspective. So there's so much to come. I really appreciate you listening. Please subscribe and rate. It takes me a lot of hours to put this stuff together. Go to the Scale Scorecard, scalescorecard.com.au, do the survey, book in for a game plan session. I can't wait to meet you in that. Let's see what you might need to address to achieve the holy trinity of options in the next 3 to 5 years so you can finally achieve the lifestyle dreams that you deserve and get a return on all the sacrifice that you've made. If I can be of service of any way, let me know. Direct message me on LinkedIn is probably the easiest, or hello@scalehq.com.au. Thank you so much for your time. Thank you so much for your patience. I know that was a long one, but I hope that you found that valuable and you were able to put yourself in there and try those mistakes on. If you're making any of them, don't sweat it. It's about action now, not about beating yourself up. Have a great day.